Welcome to Expert Real Estate Secrets, the show where real investors share real strategies that actually work. No fluff, just actionable tips to help you close more deals, make more money, and build lasting wealth. Let's get started.
All right, welcome back to Expert Real Estate Secrets. I'm Don DeRosa, joined as always by Mia, and today we're diving into one of my favorite topics, the BRRRR method. We get asked about this all the time, so we figured it's time to break it down from start to finish. No fluff.
Hey, everybody. Yeah, Don, it's honestly one of those things that sounds mysterious at first. BRRRR, all those R's. But it's actually pretty logical once you step through it, right? So BRRRR stands for buy, rehab, rent, refinance, and then repeat. It's a system, not just a catchy acronym, for building up a rental portfolio and multiplying your buying power over time.
Exactly. So let's start with buy. This is where you've got to be really picky. I always tell folks, don't just buy anything. Look for a property where the numbers make sense, good location, strong rental demand, and resale potential. After repair value or ARV, that's crucial. If the numbers don't work, the rest of the steps won't either.
For sure. And on rehab, let's get real for a second. I had a client a while back who was absolutely panicked about managing a rehab. Like, sleepless nights, constant stress. What really helped her was finding trustworthy contractors and not being afraid to ask tough questions during the hiring process. Stuff like, can you show me past rehab projects? Or, how do you handle unexpected budget overruns? Tangent, but the people you put around you on this stage can make or break your success and your sanity.
Oh, absolutely. And after rehab, you're ready to rent. This is where you get cash flowing in. Again, screening tenants well is huge. We talked about this way back in our house hacking episode, but tenant selection still makes or breaks your results. Then comes refinance. This is the secret sauce. You go back to the bank once the property's stabilized, get it appraised at its new and improved value, and pull out as much of your original cash as possible. That's how you recycle your money to repeat the process.
That's why it works so well for building a portfolio. Each refinance, you potentially get some or even all of your cash back to fund the next deal. And the repeat part, that's what really sets BRRRR apart. It's not a one-and-done strategy. If you play it smart, and let's be honest, disciplined, you can keep going, deal after deal.
Let's talk about scaling, because a lot of new investors, or honestly even seasoned ones, get stuck on this part. How do you go from one property to several without saving up giant down payments every single time? The cash out refinance is the lever. Once you rehab and get a tenant in, you refinance, not just to lower your rate or payment, but to pull out the equity you created.
I remember you shared that story a few weeks ago about the investor who started with just one rental, used BRRRR, and ended up with 7 units in 2 years. That's wild, but it's not luck. It's being intentional with every refinance and reinvestment. He put every dollar back into more properties instead of spending it. Not glamorous maybe, but super effective.
Yeah, he was absolutely disciplined about it too. Kept his lifestyle lean, focused on reinvestment, and never took his eyes off the numbers. But it's not always that easy, right? There are hurdles. Appraisal gaps are probably the biggest surprise for a lot of people. Your bank might not value the property as high as you think, which means you pull less cash out than expected.
And lenders have their quirks too. Seasoning periods, different requirements. Sometimes they want you to own the property for 6 months or longer before you can refinance. Then there's credit checks, debt-to-income ratios, stuff that can trip you up if you're not careful. It's not impossible. It just means you've got to plan ahead, build relationships with lenders, and keep your documents tidy.
Right? And don't be shy about shopping around for lenders or having backup lenders ready in case things go sideways. Each lender sees value a little differently, so having options gives you some leverage.
Okay, so let's not sugarcoat it. BRRRR is awesome, but there are legit risks at every stage. First, underestimating rehab costs can sink your deal before it starts. I had a friend who tried to shortcut their due diligence, thinking, I can rough estimate. They ended up almost losing the property to foreclosure because surprises just kept piling up. Hard lesson, build a realistic budget, and then add a contingency cushion because something always goes sideways.
Oh, and tenant headaches. Those are real too. You want to think every tenant will pay on time and take care of your property, but let's just say that's the fantasy version. You need clear screening processes and a solid lease. Then market shifts. If rents dip or values drop, your whole plan can get out of whack. Same goes for loan issues like rates jumping or banks tightening up on lending.
So Don, if you had to boil it down, what are your top tips for avoiding those big pitfalls and actually making BRRRR work long-term?
Yeah, here's my real talk. 1. Know your numbers backwards and forwards. 2. Surround yourself with a trustworthy, experienced team. 3. And this is the one too many people skip. Always have multiple exit strategies. Meaning, if the market changes or refinancing stalls, what's your plan B? Sell, hold, lease option? Don't pin your whole future on one scenario that depends on everything going just right.
Couldn't agree more. I think if you go in expecting surprises and building plans for them, you're already ahead of most people out there.
All right, let's say you've survived the rehab and the refinance. You own one or more rentals now. This next part is where you really make or break your long-term wealth management. You need a property management plan that isn't just, I'll call a handyman when something breaks. Set up regular maintenance, seasonal HVAC checks, annual roof inspections, preventative pest control. It's not exciting, but it saves you so much in the long run.
And tenant experience counts too. If you want to avoid chasing down rent or dealing with late-night emergencies, have a clear, friendly communication system with tenants. Set expectations early on, how to request repairs, what's covered, how to reach you or your manager. It goes a long way in keeping good tenants for years. Tenant retention, by the way, is huge for cash flow stability.
For the business side, track everything. Rent collection, expenses, repairs, your actual profit. It all needs a spreadsheet or, better yet, a good property management software. That way, you can make smart decisions about whether to keep, sell, or refinance again in the future. Also, stay on top of your local market. Be proactive when it comes to new landlord-tenant laws, tax changes, or even rental market trends like we talked about in the house hacking episode.
If you want to really take BRRRR to the next level, you need systems. Like, don't just gut feel whether it's time to look for your next property. Use cash flow calculators and do market research to pinpoint where demand's growing and prices make sense. You don't have to be a spreadsheet junkie, but you should know your numbers cold.
And build in routines for evaluating each property every year. Ask, are your rents where they should be? Are maintenance costs climbing? Any recurring repairs that hint at bigger issues? The more consistent your reviews, the less you'll get blindsided. Plus, as your portfolio grows, you want a network, not just other investors, but great property managers, solid attorneys, and tax advisors who know investment real estate. Scaling smart means building that team as you go.
Yeah, the right support makes all the difference when suddenly you're managing 5 or 10 units instead of just one. You can't go it alone forever, especially as laws and market conditions keep shifting.
Let's geek out on tax benefits for a second, because honestly, this is where a lot of your profit hides. When you rehab a property, a lot of those expenses are deductible. Then you've got depreciation, an annual tax benefit just for owning rental property. Mortgage interest is another nice deduction.
And then, of course, there's the 1031 exchange. We won't go too deep in the weeds here, but basically it lets you swap one property for another, defer your capital gains taxes, and keep your money working. It's a game changer for portfolio growth if you use it wisely.
But you can't just wing it. Good tax planning is proactive. Keep clean records throughout the year, document every expense, save your receipts, and make sure you're working with a CPA who knows investment property. They'll help you find deductions you'd never spot on your own and keep you out of trouble with the IRS at the same time.
Yeah, if there's one place not to DIY, it's taxes. Shortcuts here always backfire. One thing we see again and again, whether you're starting out or scaling up, is how much your network can make or break your BRRRR journey. Start with real estate agents who specialize in investment properties. They'll get you the good deals early. Build relationships with lenders too, since every deal probably has its own financing puzzle.
And don't skip the meetups. Local investor groups, REIAs, contractor breakfasts. It's not just about swapping business cards. You meet rehabbers you can trust, property managers who really know the local market, even other investors you can joint venture with or learn from. Some of my best deals and partnerships came out of conversations over bad coffee at 7 a.m.
Sometimes it's the bad coffee meetups where the real magic happens. I always tell folks, look for a mentor too. Having someone who's been through the BRRRR grind can save you years of trial and error. Plus, they usually know all the local pros you'll eventually need.
All right, last piece, and arguably the most important if you want staying power. Set a routine for inspecting your properties, even if you've got a manager. Early detection on repairs saves a fortune. Happy tenants stick around longer too.
And stay responsive. Open communication channels, quick service requests, regular check-ins. When tenants know you care, they care about your property too. It's just one of those cycles that keeps things running smoothly.
And don't sleep on reviewing your financials. Use reports, not your gut, to find out where you can tweak rents, trim expenses, or figure out where to reinvest next. This is how you keep the BRRRR engine running year after year instead of stalling out.
So, that's a wrap for today's BRRRR Deep Dive. Hope we've made it a little less intimidating and maybe even a little exciting. If you've got questions or want us to break down any part further, let us know. Don, always enjoy these chats with you.
Same here, Mia. And thanks to all of you tuning in. Don't forget, this stuff isn't just theory. We're out here doing these deals every week. So if you missed any details, go back and listen again or check out our previous episodes for even more strategies. See you next time.
That's it for today on Expert Real Estate Secrets. If you're ready for hands-on coaching and real results, go to www.expertrealestatecoaching.com right now. Join the community, get the tools, and start closing more deals. We'll see you on the next episode.